everyone. Gerry Hogenhout here with Canadian Investment Services. Welcome to another one of our episodes of our tax and investment snippets, where we take a topic, we just have a little brief discussion about it, just to better inform you, give you some education about these topics. Today we're going to talk about something that's called return of capital. And some people know what this is, too many don't. Return of capital is a way, it's a method of receiving a income from your investment. Okay, the normal returns that we get from investments are usually interest, capital gains, and dividends. Okay, each of those sources have tax consequences. So if we earn interest, if we buy a bond, if we lend money out in a mortgage, we get interest. Interest is fully taxable. Okay, so if we earn $100 of interest, we have to put $100 on our tax return and pay tax at whatever tax rate we're paying at. If we earn income as a dividend, there's what's called a dividend tax credit, which is basically a credit for the corporate taxes that have already been paid from the dividend that you've received. So in discussion to better understand it, if you received a dividend, you're going to pay, if you received a $100 dividend, you will pay tax on 3/4. You will pay tax on 75% approximately. Okay, so the difference to 25% is what we call a dividend tax credit. So it's tax preferred. Okay, so again, if we earn interest, if we earn $100 of interest, we have to put $100 on the tax return. If we earn $100 of dividends, we only have to put $75 on our tax return and pay tax. The third option, the traditional return on investment, is capital gain. If we generate a capital gain with our investments, then we only have to put half, 50% of the gain on our tax return. If we earn $100 of capital gain, we only have to put 50% of that, $50 on our tax return. So there's some tax preference there. So again, recap quickly, interest, 100% taxable. If we earn $100 of interest, we have to put $100 on our tax return. If we earn a $100 dividend, we have to put $75 on our tax return. If we earn $100 capital gain, we only have to put $50 on our tax return. Now, there's a fourth way, and it's called return of capital. Okay, now what the heck is that? The beauty of it, I'll start right off the hop with the advantage of it. When we earn income from our investment by way of return of capital, we pay zero income tax, nothing. If we earn $100 by way of return of capital, we put zero on our personal tax return. Okay, that sounds pretty good, and it is. Where do we find return of capital? We usually find them in real estate income trusts that invest in real estate, in apartment buildings. Okay, some of you may know what a real estate income trust is, a REIT, we call it. In simple terms, it's a fund that buys apartment buildings. Okay, a residential REIT. I mean, there's different types of REITs. That's a topic for another day. I like the residential REIT. So a REIT, real estate income trust, is a fund that buys a multitude of apartment buildings. Inside the REIT, the company that manages it, they collect the rent, they pay all the bills with the rent, they take their management fee, and they distribute the net rent to the investors, you, okay? And that distribution is usually, not all the time, usually in certain REITs under most circumstances, is return of capital. You pay no tax, okay? So if you put $100,000 into a REIT, and if the distribution was 6%, you would get $6,000 a year, you would get $500 a month, and it's not taxable. It does not go on your tax return. Now, there's all kinds of good things that happen if we don't have to put money on our tax return, especially later on in life. A REIT is a great vehicle for not only young people, not only middle-aged people, but a great vehicle for seniors. Because we don't have to put the income on the tax return. So how can that be? Very simply, inside the REIT, again, there's a bunch of apartment buildings. They're collecting all the rent. That's easy to understand. They're using that money to pay all the bills, and they take their management fee from that, and the residual they distribute to the investors, as I said before. Inside of the REIT, they're allowed to claim depreciation on those apartment buildings. So inside of the REIT, whatever the income is in the REIT, they bring the income to zero by claiming depreciation. So the REIT itself has zero taxable income. Then they distribute to the investors. And so in theory, there's no income inside the REIT, and that's the reason why it's not taxable. Okay, that's what we call return of capital. Now, what does happen is whatever you receive by way of return of capital reduces the cost base of your investment. Follow me here. You put $100,000 into an investment. You get 6% distribution. Okay, and it's return of capital. You don't pay any tax. Your adjusted cost base of your investment has gone from $100,000 to $94,000. Okay, now next year you sell it. Your $100,000 is worth $105,000. Okay, it's gone up 5%. So not only did you get a 6% distribution, your investment also went up 5%. So you made 11%. Okay, now for tax purposes, again, our original investment was $100,000. We received $6,000 as return of capital. So we didn't pay tax on the $6,000. So we reduce our cost base. We go from $100,000 to $94,000. Now we sell for $105,000. Okay, we have, what is that? An $11,000 capital gain. Proceeds of disposition, $105,000. Cost base, adjusted cost base, $94,000. Capital gain, $11,000. Half of that is taxable, so we only pay tax on half of it. Now, hopefully you can follow that, but the crux of it is we're getting the distribution for free, and we're converting our investment from what would normally be taxable to a capital gain. So it's a win-win. We win because we get the tax-free return of capital distribution, and we win because we're converting our investment into a capital gain, which is only half tax. So return of capital is a great thing, works very, very well, but you'll only find them in these real estate type of REITs. So anyway, I hope that helps. Hope you have a better understanding of return of capital. Glad to chat further with that, but for now, that's it for today. So thanks for joining me, and we'll see you on the next session. Thanks. Bye-bye.